afternoon, everyone, and welcome to Unlock the Stock. As you know, this platform is designed for retail investors to gain access to corporate management and to get to know them and their companies just a little bit better. This episode is sponsored by Easy Equities, a platform that helps you grow and protect your wealth, where you can invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs. Plus, you get access to Easy Protect life insurance and Easy Credit lending to back your financial journey. We are very pleased to welcome back Calgro M3 today to Unlock the Stock, and this is a record 7th time that they will be joining the Unlock the Stock presentation and session with us today. Today on this show is Ben-Pierre Mahaba, the new CEO of Calgro M3, and Sari Naka, the FD, who will take you through a presentation shortly. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their website at lumiglobal.com to learn more about the various online AGM and investor presentation solutions. Our hosts today are Mark Tobin and the Finance Ghost, who will lead the Q&A session. Before we start, there are just a few housekeeping notes. Ben-Pierre and Sari will take you through a presentation, which will be followed by a Q&A session. You can post your questions by typing them into the Q&A box, which is at the bottom of your screen. The event is being recorded and will be available on our YouTube channel soon, together with about 40 other videos that you can take a look at. You will see an email address when we go into the Q&A session, and if you would like to be added to Calgro's distribution list, please send us an email and we can add you. Ben-Pierre and Sari, I am ready for you to share your presentation and to take us through the presentation, please.
The pertinent points, then I'll hand over to Sayuri, and say 20 minutes in, we'll get to the question and answer session. If we look at the year under review, it's been an interesting year, and I think the year has been marked by deliberate slowdown in construction. That was a result of the elections and lessons learned in 2019, when the group was exposed by having a lot of half-built units in the lower end of the market. They were invaded, and it resulted in a whole process of getting people evicted, and some of those numbers are only coming through the financial results and the revenue in the 2025-26 years. So it was a costly mistake at the time, and I support the decision, and I think the decision made at the time was to say, slow down the construction of units and rather focus on infrastructure that can't be vandalized or illegally occupied. So the intention was to slow down leading up to the elections, all good. What was not expected was that the formation of the GNU will prolong this staying off-site. The GNU, although in the long run, I think we support that as the right move we're going in, but it caused a lot of uncertainty in the market, and working specifically with the city of Johannesburg, for example. We ended up working with the acting city manager, working with the acting executive director housing, that made it difficult to actually transact and do business with the city in these uncertain times. So what happened as a result of the slowdown? Like I said, it lasted longer and the focus moved towards infrastructure. Also what happened is the exposure to public sector in the lower end of the market was reduced, and the group moved back into the little bit higher end of the market, our top end of the market. And as a result of that, the revenue was delayed. So it's not something that's completely gone, but the handovers were delayed. And because it took longer to get into construction, we couldn't complete the construction cycle, and units weren't ready for handover and transfer out to end users by end of February. Just keep in mind, our revenues recognized as revenue as soon as we transfer these units out to the end users. And in this case, some of these units were not completed. And to give you an example, in May this year, 180 units were completed in Jabulani that was supposed to be transferred and handed over in the previous financial year. That will only be reflected in revenue this year when they do transfer out. It's difficult to do a calculation and see exactly how much we missed, because we can say how many units should have been completed, but there's no guarantee of how many of those units would have been transferred to end users and would have reflected in revenue in the reporting period. So if we, move on here. If we just look at the picture and we're going to look at the two sides of the business. On the development side saw a higher margin during the period under review. We were unlocking value created in past years. If you look at Fluof especially, where the margin reached 27%, I think. Our target market is anything between 20 and 25% margin that the group would like to see on the development side. So how did it happen that the margin increased in these tough years? Must keep in mind, as you move away from public sector into the private sector, we sell units to the open market. And when you sell a unit to the open market in 2025, the banks don't ask you when you bought the land or what you paid for it. So in Fluof's case, this is a project that was acquired in 2010 already. So we've had the land for a long time. We as a group don't revalue our land portfolio, so it will be in book, on book or balance sheet at cost. So when we unlock this and we actually transfer this out to the private sector in a bigger percentage than initially anticipated, that resulted in unlocking some historic value that was trapped in there. Because by transferring out these completed units, you actually realize the value at current rates of the land, and you unlock the infrastructure investment that was made over the past couple of years. So on the development business, we were above the target market. The revenue were down 32%, but if you look at the combined revenue was down 11.5%. And the difference between the revenue and the combined revenue, some of our projects we do in a JV, it's not on balance sheet, and the specific project that was targeted for completing construction before the year end was the South Hills development in partnership with Standard Bank, where they're the funding partner on that, and that's resulted in the combined revenue down 11%. So yes, the revenue was down, although the margin was up, and we're looking at a stable debt to equity at 0.65, sorry, my apologies, 0.65, stable year on year for the last couple of years, stable at that. That's, you've got to compare that to internal targets of 0.75 and our covenants at 1.5. So we roll within that. We can also see the net asset value grew, and that was just a result of the investment of land when we acquired the Bankenveld project, where we paid the last of the option fee of 100 million rand, and we invested 226 million rand in infrastructure during the year, of which 208 was on the development business. If we just quickly look at the Memorial Park side of the business, we had a great year for the Memorial Parks with year-on-year growth of 41% and the margin at 50%. And I think the biggest contributing factor to the Memorial Parks growth is the fact that a call was made years ago that the entry level into this market is high. The LSMs we would like to target is lower than that. So a lay-by product was introduced where you could acquire the grade by a down payment of over 6 months up to 24 months cycle, and a whole lot of these units or lay-bys came to maturity. We only recognize this as revenue once the last payment has been received. So as they got to the 24th months 24, and those reflected in turnover and revenue. Oh, sorry, actually jumped ahead on that one. Okay, if you look at the other metrics, so financially, we've got to know where we stand. So you will go into the more detail now. So we know that we talked about that. The other operational metrics, the group actually did well. If you look at our empowerment targets, where we target 50% women employees, we're currently at 47. We maintained our level 1 BEE rating. The Bunkenveld project was transferred. So I think we've had a good year overall. And if you look at all the matrices with regards to maintaining our accreditation for health and safety, the group was stable. I think we had a stable year. It was just a question of revenue that was down. If you look at the pipeline, and I think the important message on the pipeline is, with the acquisition of the Bunkenveld project that added another 20,000 units to the pipeline, for the first time we were in a position to differentiate between core pipeline and non-core pipeline or non-core projects. And the difference is, it's nice having a project on your pipeline and say we've got the opportunity to develop 14,000 opportunities in the Eastern Cape, but if it's not the intention to develop them in the next 3 to 5 years, they shouldn't be reflected on the pipeline. So we took some of these projects off the pipeline, project that we will consider disposing of, to refocus on fewer projects that's contributing. Important to note on this, that pipeline always needs to be balanced between new projects. One project can't dominate your pipeline and become too dependent on that. So we need a mix of new projects coming online that is hungry for infrastructure development, but you need to balance that with existing projects that's actually generating cash from operations. And if you look at the flow of project, it's been coming a long time. There's 6,000 opportunities left on that project that's currently contributing. We're looking at South Hills and the Ballard projects. We need to have that balance. So the pipeline, we've got a strong, healthy pipeline, and the pipeline that we currently reflect, the 36,000 opportunities, as actual opportunities you would like to develop in the next 3 to 5 years. If I just touch on the implementation, where our growth is coming from, and it comes back to the hashtag sustainable growth. If you look at that first step on the slide, we're talking about capital allocation. That will always be a combination of ensuring working capital. We need sufficient working capital to keep on growing, invest into new infrastructure that will allow us to grow sustainably. The debt to equity, like I said, is stable. And I think the capital allocation is something that will be a continuous discussion between what is the opportunities available and where do we get our returns from. If we look at the development business itself, we say we would like to increase the open market sales, and I think there was a message in the roadshow that was taken out of proportion by one of the media, doesn't make a difference, where we said it looks like we're looking at bulk sales. Bulk sales is something we've been doing since 2010. So we differentiate our client base as a guy walking through the door and say, I'd like to buy a house. He transfers and he moves into the unit. And on the other side, the client that comes in and says, I want more than that. I've got a rental portfolio. I'm looking for a portfolio with a body corporate of 300 units, and we do that. And whether that's social housing, aimed at one of our social housing clients, or someone in the affordable rental market that buys stock for the rental market, we've always been doing bulk sales. So the comment to say we will increase our focus on bulk sales is just to offload some of these units that we're carrying on balance sheet. We're carrying more units on balance sheet that we might like to. There was a number thrown around. We came through year end with about 300 million rands of stock, completed units that's going into the market. And that was a second message that might have come across wrong. Where having stock is not a bad thing. We're entering a recovering market where there's a lot of people coming back into the market that stepped back from delivering houses in a downward cycle, interest rate cycle, where the consumer was under pressure. The consumer is still under pressure. We haven't seen the declining interest rates making a big contribution as yet. But if you look at the recovering market, there's companies that will come back during this period and say, guys, we're happy to buy land again. We're happy to invest in infrastructure. We're in a fortunate position where we've invested in infrastructure and we've got infrastructure ready for implementation. So our reaction time to this recovering market should be shorter than some of the competitors returning back to the market. If we look at the market share, just a comment on the market share, the Memorial Parks business has grown, and I'll say that's a good business to have. Biggest reason behind that is being in the development cycle. Some of these cycles are longer than our 12 months reporting cycles, and we're going through lumpy cash flow. And because of that, also our revenue comes through as lumpy. The Memorial Parks has collected 95 million rand in cash during the reporting period, and that was equivalent to our group overheads, and that gives us the opportunity to do the development business and allows us to go through these cycles without being dependent on the returns from the development business. Liquidity is more than just the financial liquidity. We're also looking at human capacity or talent capital that the board would like us to refer to going forward. But I think liquidity is important, and we need to look at our capacity. And our capacity, we will balance once again without growing the overheads disproportionately. We would like to say there's some of these projects that's taking up some capital that we will rather dispose of, and that's something we'll balance with growing new appointments and unlocking capacity that we currently have and actually not utilizing currently. If I move on to some of the other metrics, I mentioned that earlier, and I'm just going to glance through this. We retained our accreditation for health and safety. We were fatality-free again for the year. The Global Compact, our independence on the directors, I think we had a good year in the rest of the reporting periods, and I'm not going to dwell too long on some of that and come back on questions if we need to. Just on the underlying business performance, if I can go into a little bit more detail, I've touched on the integrated development. That will stay our core business. We made a commitment that strategy won't change overnight with a change in management, and the residential development will stay our core business. We might move away from the high end of the market, and strategically a decision was made to exit KZN, for example, but the core business will be the development business. Saying that the Memorial Parks, like I said, is an attractive business. The contributions grew from a 4% to an 8%, and we'd like to see that grow in line with the growth in the company. If we touch on the market itself in the development business, we're in a recovering market. The market has always been there. There's no doubt that we, as a country, we're facing housing shortages. What we see happening currently is a recovery of consumer confidence. People are more prepared to put pen on paper and actually sign an offer to purchase. But the more exciting part is actually the appetite of the financial institutions returning. So we see the normal, our core market recovering, but we also see a recovery in rental opportunities. We see a new type of bulk deals coming through where clients come in and say, I don't want 1 unit, what can I maybe buy 6 units or 19 units? And these guys are buying it for that. Calgro made the call some years ago to exit the REIT market. We're not involved, we don't hold rental stock, and there's smaller parties entering into the market currently and saying, guys, we will take up that opportunity. We will buy into an existing development, existing body corporate, and happy to own 20 units and rent them on their personal basis. So the group has got no intention to step back into that, and I think we've just opened the door for a new market that's emerging through that. I touched on the pipeline. where we say this is the core pipeline, this is what we would like to see developed in the next 3 to 5 years, and there you can see the healthy balance. We're talking about existing projects contributing and new projects coming online. The exciting thing, and I'll come back to Bankenveld, the Bankenveld project that will unlock 20,000 additional, and that's a minimum. We've secured rights for quite a bit more than that, but the conservative estimate is that there will be at least 20,000 units developed in the development. If you combine that with projects like Fleur of Jabulani and South Hills, that's been coming from anything from 8 to 15 years, that's currently contributing and generating cash from operations, that's the balance we need to maintain. If you look at our exposure, currently mostly Gauteng and Western Cape. The Eastern Cape is not a priority at this stage, and that's why you won't see the KwaNobuhle project, the 14,000 units on that pipeline anymore. We are in discussions with the provincial government and looking at the options of that, but unfortunately, we can't justify spending 150 million on Vulcan Link infrastructure investment in the Eastern Cape if we've got access to a project like Bankenveld close to the Sandton CBD and the new waterfall hub that's competing for Vulcan Link infrastructure. So this is based on core we would like to unlock in the next 3 to 5 years. I'm not going to go into, I talked about the market demand. The market demand has been there. We just see the consumer confidence returning and the appetite of the banks increasing. If we look at the Bankenveld project, like I said, is a project that's been coming for a long time. It takes years to get these projects to implementation phase. We took transfer of this land in September last year. This is land that was owned by Wits, the university, for the last 102 years. We took transfer this in partnership with Eris, who will be developing the commercial, retail, industrial component of the development, and we will only be involved in focusing on core business delivery of residential opportunities. So we took transfer of the land in September, we paid the last of the option fee of 100 million rand, and we're actually on site currently with the installation of Vulcan Link infrastructure. To give you a sense of the Vulcan Link infrastructure required, if I just quickly put the location of the project up there, the project is on the one side bordering onto the N3 close to the Marlborough intersection, and on the M1 at the Woodmead intersection. So that's the property that's been unlocked. And for the next 18 to 24 months, we will only be unlocking infrastructure. That is the bulk required for us to be enabled, or that will enable us to construct these units, and that's mainly road infrastructure required. We need to do an upgrade on the Woodmead side, on the old Pretoria Road, where intersection needs to be upgraded. We need to look at the intersection on Marlborough Drive, that strategic link between Marlborough and Woodmead. We also need to do an undercarry under the N3, unlocking, we see in front here, the business opportunities. That's the job opportunities there in the industrial areas. We need to unlock that. So initially, we will be doing infrastructure, road infrastructure mainly. We've got sufficient electricity to build 9,000 opportunities. We've got sufficient water capacity in the area to unlock that. So the first trigger will be if we upgrade the roads. Phase one of that bulk infrastructure will allow us to do the first 5,900 residential opportunities that will be developed over the next 15 years. Our contract with Wits allows us to roll this project out over a 15-year period. I think that for the first time, it's an exciting project to get involved in. For the first time, we've got the opportunity to reset integrated standards. When we launched the Fleur project in 2010, 10, 11, 12, we were on the front page of the annual report of human settlements for the integration that was done. I think this project allows us to change those and set new benchmarks with regard to integration. And if you just look at a press release out of the President's Office on 7 May this year, there's phase 2 of this operation, Vulindlela. The comments made are, we need to bring our people closer to job opportunities. We need to stop building cities on the periphery of our existing cities and bring people closer so they don't need to spend 40% of the disposable income on transport. And I think this project is ideally located to cater for those needs and the new direction that's been taken by the National Department of Human Settlements. I'm going to quickly touch on memorial parks. Market demand is still high. We're still operating in an environment where there's a lack of service delivery from public-owned parks. We're also competing with parks like West Park in Johannesburg that's reaching capacity, so it's end-of-life parks. I think there's a lot of scope to grow. We've got, once again, a healthy pipeline on these projects. And if you see what we're dealing with, once again, it needs to be a combination of existing parks. Nasrec was that first park that we bought and brought to market. That thing, the park has got a 10-year lifespan left with a lot of land for growth into that. And we need to combine that with something like Platinum City that was supposed to be online middle of last year. We experienced some town planning issues, and that project will come online Q3 of this financial year. So once again, a healthy balance between existing parks currently contributing and bringing new parks on board to keep the growth. Once again, hashtag sustainable growth that we're talking about. Where to from here? If we look at, I'm not sure when is it. Sorry, I'll skip the slide here. Sorry. Where do we want to go from here? I think on the development business, we need to get back to core business. We need to increase our construction activity again. Our delays led to delays and delay in revenue. We need to get back into that. At the same time, we're carrying stock. So our reaction time should be quicker than some of our competitors. We need to unlock some of that completed units we're carrying on balance sheet. We will not stop the investment in infrastructure, but of the last 2 years, a lot of focus was on the investment in infrastructure on our existing projects that need to contribute to cash generated from operations, and that will allow us to invest our infrastructure into the new Bankenveld project. Our debt to equity will be managed. We've got internal targets of 0.75. We're still well within that. Would we increase our debt to equity in the short term? Short term, with the Bankenveld project come online, that might be temporary, but we are comfortable on that 0.665 that we currently find ourselves at. We will also look at the disposal of some non-core assets, and we've started that process. I think it's public knowledge and has been coming for a while that we said we would like to exit KZN after some bad experience with construction mafia and all that. Although that's been addressed, the group will not go back and establish a presence in KZN just to roll out the last project. So we are in discussions with interested parties to dispose of that. That specific project, our exit out of the Eastern Cape is for different reasons. Like I said, it's difficult to compete with a project like Bankenveld coming online, and we've got options there. And also on the mid to high, the high end of our market segment, the group still have properties acquired some years ago aimed at that market segment, and we will look at disposing that if the opportunity arises. So while we're growing into Bankenveld, we need to unlock investment and value trapped in our existing pipeline. We'll balance the two and try and keep that a healthy combination, and doing exactly the same in the memorial parks. Unlocking some existing opportunity in the existing pipeline and while growing at the same time. I'm going to hand over to Sayuri first, right, on the financial side, and then we'll come back to a question and answer session.
Thanks, Ben-Pierre. I'm going to quickly go through it because I think Ben-Pierre has mentioned quite a few of the financial metrics already. So just going to quickly just give a bit of a high-level overview of where we ended the financial year. From a cash flow statement, and that's generally where we start looking at the business's performance, cash generated from operations has reduced to 107 million, and that's primarily as a result of that deliberate slowdown that Ben-Pierre mentioned in construction activities in the previous financial year, giving a result of just a reduction in cash generated from operations and net cash generated from operating activities, bearing in mind that what we have done is invested into our balance sheet in investment in infrastructure. So in the year, we've invested roughly 208 million rand in the residential development business in infrastructure, inherently servicing the pipeline, which will give us serviced opportunities for future periods. Looking further down the statement of cash flow, proceeds from borrowings increased to 305 million, with our capital repayments of 158. Now within that 305 is a portion which was refinancing the repayment of the 158, and then just a little bit of an additional debt raise as a result of our Bankenveld project where we pay the option fee. Dividends paid for the year. So in the year, we declared, in the previous financial year, we declared our maiden dividend, and it was paid in the 2025 financial year of 10 million rand, giving us a closing cash and cash equivalents balance of 154 million rand. Ben-Pierre has touched on the reduction of revenue by 32%. Now, when we as a group look at revenue, we look at a thing called combined revenue. Now, this is not an IFRS measure, but what it does is it takes into consideration the revenue that's generated within the joint ventures. Now, the reason we look at that is because in order to generate that revenue, there's a lot of human capital, financial capital, and various other capitals that are invested by the group in order to generate that revenue within the joint ventures. And it's a capital allocation decision that's made at a group level to invest within the joint ventures. When looking at that combined revenue decreased by 11% for the year. Now, residential property development business does contribute mainly to our group's performance in the year. However, that being said, Memorial Parks has done exceptionally well in the current financial year, increasing its revenue by 41%. The main driver of that increase in revenue is the lay-by, it's a maturity of our lay-by book. Now we recognize revenue from the lay-by book once the lay-by transaction has been fully paid for. So what we're seeing here is just the maturity of that of certain transactions coming through on the lay-by book. Looking further down the income statement, our gross profit ended the period at 29%, above the target range of 20 to 25%, but that's driven by the benefit of that historic land cost values, as well as the mix of our sales moving away from subsidized units into the open market. Administrative costs have decreased to 95 million, with our share of profit of our joint ventures increasing to 42 million as a result of that capital allocation decision made to invest within the joint ventures, giving us a profit after tax of 166 million rand, which is a reduction of from the previous financial year from 195 million. Then just working through our balance sheet, that investment that we made into infrastructure and into investing into our balance sheet, which has not yet generated cash from operations, is the increase from 1.3 million to 1.6 million. Joint ventures increase is directly related to that investment into our joint ventures for the financial year, giving us a closing asset base of 3.2 billion rand. And then just looking further down, I'll touch on our borrowings as we move to the next slide. So I mentioned the increase and the repayment of borrowings. Looking forward at our maturity profile, we have roughly 301 million rand of debt maturing in the 2026 financial year. Approximately 250 million rand has already been refinanced, with refinancing on the maturing debt currently in discussions with various debt holders. The intention of the group is to refinance maturing debt on an ongoing basis, as we are very comfortable with our net debt to equity and ratio as it currently stands at 0.65. Benbia has mentioned that the internal target is 0.75. We do believe on an ongoing basis we will not breach the 0.75 internal target that has been set. The other covenant that we do regularly report on is our debt service cover ratio, which is at 1.38, which is above our regulated covenant. And then finally, just from me, a dividend has been declared at the end of the financial year, which is based on our policy of 5% of HEPS. So the dividend of 8 cents per share will be paid on the 2nd of June 2025. That is all from me. Yes, thank you. I think that's
back to Vanessa.
Great. Thank you very much. I'm going to hand straight over to the Finance Ghost and Mark to take everyone through the questions.
Hi, Vanessa. Thank you so much. Thank you to the team at Calgro and to everyone for attending the call. As I joked in Ghost Mail this morning, we can't help you unlock your door, to sleep with it like that, as per Johan Rupert, but we can help you unlock opportunities on the JSE. So thank you for being here and for just helping us do that, I suppose. So yeah, to the team at Calgro, I think just to kick off, something interesting I think that I picked up there from the presentation, and something I just want to ask before we dive into other questions. You were talking about how you need to upgrade the intersection there, the new project, etc. I just wanted to understand where some of that spend actually sits. I mean, is that a spend for the roads, surrounding roads, etc.? Is that something that sits with the developer essentially? Is that something that sits with the city? And then I guess the broader question there is just, I guess if you could give more information on how you think about these really long-term projects. I mean, that's quite a capital modeling exercise. Money gets tied up for a few years in infrastructure before any units actually start to get sold. It's just would be interesting to understand a bit more about how you see that. What are some of the metrics you look at, etc.?
Okay, if I can start with just the question around the bulk infrastructure and that the major roads infrastructure. That is an asset that would be handed back to the city of Johannesburg, those intersections with Joburg Roads Agency, and that will be funded by a public sector exposure. So if you look at the exposure split between public sector and private sector, the Balkan link will generally come from the city of Johannesburg as a metro, as that asset will ultimately end up with Joburg Roads Agency. Then we'll have some exposure with the province itself, where the province is looking at the finance of internal infrastructure, not the finance. It's a grant that you qualify for if you aim at the right market segment. So in the subsidized and semi-subsidized market, that will come from the province itself, and the province will also pay for the construction of the top structures. The private sector component will be the top third of the development, where you are partially subsidized. The companies specializing in affordable rentals, for example, and where we breach that top end of the market. So the current market is capped, or the intention is to cap it at the gap market through the financial institutions. So it's a joint income of 38,500 Rand monthly income. So that is the target market we're targeting. So yes, this is a combination of public and private sector investment that will unlock this development. If you come to the duration of this project and the long-term commitments that it requires, if you look back at Fleurhof, the intention was not to develop Fleurhof over a 15-year period. It's 15 years in the making. But what you would see is the initial investment is public sector investment to unlock this development. The land is privately owned, and just to touch on the structure of this development of Bunkenveld specifically, The Balkan Link infrastructure will be doing a joint venture with Eris, where Eris will, on completion of the bulk and link infrastructure, extract all the land components that's aimed at the commercial, retail, industrial side that will transfer to them to develop for their profit and loss, and we will transfer all the residential opportunities to us. But by that time, we get back a product that's been improved. The bulk and link will be in there, and the multiple on the value would have been realized, where it's not only land value that you have on balance sheet, but you've actually got land value improved with rights and infrastructure, internal infrastructure and bulk infrastructure installed for this development. You could answer this. I'm not sure if there's something you want to add, Sayuri.
Yeah, I think from a modeling perspective, how we generally look at it is what's critical for the group is a diversification across projects. Because as you do mention, these projects are quite long-term in nature. So as we have done in the previous financial year, we've tried to ensure that roughly about 76% of the pipeline has been serviced. And what that awards us, it awards us an opportunity to turn opportunities on some of our older integrated developments quite in a faster time frame, because we no longer need to install as much services, because that is where a bulk of your cost upfront as well as time goes. So what that gives us from Bankenveld's perspective is that will be an 18-month runway from an infrastructure installation perspective, but we can diversify across the projects to assist from a cash flow modeling perspective to supplement Bankenveld over the next 18 months, as most of them already have the infrastructure installed, so that will just be top structure and cash flow happens at a much faster rate.
Saria, maybe if we stick with you, I've got one question. Well, actually, two questions related to the lay-by option in the Memorial Parks business. So the one is, you pay over 12 or 24 months. And from an accounting perspective, the cash flow and the revenue only gets booked at the very end when the final installment is. So one is confirmation that is correct. And then the second question is, what happens if somebody, doesn't complete the full lay-by option, whether they've taken 12 or 24 months, I don't know, they decide they're moving from Joburg to Cape Town, or, moved somewhere else in Joburg and it's not close to, where the initial kind of plan was for a burial site. Do you keep the cash? Does it get returned to them?
Okay, so the lay-by option is the period varies, as you mentioned, it's between 12 and 24 months. We do only recognize revenue once the transaction has been fully paid for. So up until that point, it'll sit as a deferred transaction on the balance sheet. If the client decides to cancel the lay-by transaction within that period, we do refund 100% of that balance. So we don't keep the money, if the client does cancel the transaction.
Okay, and then the second question was, obviously the lay-by option has been in place for a while. I can't remember what Ben said about when that kicked off, but are we basically at a point now where that kind of book maturity is in place? So there's every month there's a 12 or 24 month contract coming up. It's not this long lead maturity time now. It's basically every month there's obviously the growth in the book starts to come through as well, but basically there's cash flow and revenue getting booked every single month now, because we're at that kind of mature end of the book.
100%, and that's actually why we see that growth in revenue in the Memorial Parks business in the current year, because we've gotten to the point where the 2-year cycle has passed, and now the replacement is coming through on a monthly basis. So it's actually quite a healthy book at the moment from a replacement perspective.
Okay, perfect. Thank you.
Maybe if I can just go back a little bit to the capital modeling on some of the projects, because obviously I think the sort of the way you think about cash flows and everything else is so important. And do you look at target hurdle rates from an IRR perspective? Is it an NPV thing? Is it a return on equity thing? I think it just helps investors understand maybe, what are the metrics that you guys are focusing on? And then it kind of helps them think about over time what they need to be looking at as well.
Look, from a general perspective, with regards to the projects, we assess the project and assess the broader project from a blended margin perspective. And that's where we try to peg a blended margin between the 20 to 25% range. We do look at it from a blended perspective because generally, depending on the typology and the type of what you're building at a point in time, certain things make different margins, which is why we go from a target range between 20 to 25%. So that's generally the return we expect from our particular projects over a period of time.
We've got a question on succession here, Ben, and more broadly on obvious, this year, as Vanessa said at the outset, your Calgro 7th time here, but your first time. We've had Vikas and Valdi here previously. So just a question on, obviously they had been with the business a long time. They've now moved on to different opportunities. Just a question on the board and, in terms of replacing, their know-how, Valdi and the Memorial Parks business, Vikas on the more on the development side, and just broadly within the whole Calgro setup, getting people with, that kind of like skill set and industry experience in at the, the high level, whether that's externally or, what's been lying underneath there, promoting people up who've got to that stage in their Calgro journey that they can step up into those roles.
Mark, yeah, thank you. If you go back when we started the Fleur of Project, I must say I've been involved with Calgro since 2000 and was part of the team when we acquired the Fleur of Project in 2010. I worked with Vikas for a long time. I appointed Vikas as CFO at the time, and we worked together until I stepped away as CEO and Vikas took over. And this is just my return coming back to the company. I think the exit of Vikas and Valdi at the same time did leave a hole. There's no question about that. I think the Memorial Parks, we are comfortable that Brian, who's heading up the Memorial Parks, currently is doing a great job. You see it in the numbers. We're seeing it on a month-to-month growth and where it's going to. On the Exco side, in the internal, yes, we are looking at growing our capacity internally first. We're currently going through a process where we've just appointed a new head of marketing to assist with this new initiative to increase our focus on the bigger sales and the bulk deals like we explained. So on the marketing side, we saw a shortage there and we've already created the capacity there. Our new head of marketing started beginning of May. On the operational side, we've split operations between the implementation side and the planning side leading up to that. We've got a good team, but the team will be supplemented by external. I don't think it's possible just to grow internal. But that, like I mentioned earlier, will be a combination between unlocking some existing capacity. We've got a team that knows how we do things, but it's currently tied up in unproductive projects. So we need to look at the disposal of some of this non-core assets and unlock some of that capacity. So it will be a combination of internal and external appointments.
Yeah, great.
I've got a question here in my DMs just about a realistic annual run rate for the number of units that you can sell and transfer to customers in the current market conditions. So obviously, those current conditions are quite changeable given the interest rates. But I guess, again, just investors looking to maybe model out the business and get a sense of it. What do you think is a realistic annual run rate for units?
If you look at the past, last year we did 1,500 units. The previous, not this reporting period, the previous one, 1,500. This dropped down to just under 1,000 units at the end of this interest rate cycle. We need to ramp that back up. I'm not saying we're going to hit the ideal target rates this first coming year. We're building up capacity again, but we need to build up the capacity to in excess of 3,000 units. As soon as we get to the Bunkerveld project contributing, you will see some substantial growth there. If you look at the Bunkerveld project and how do we get the numbers by the time you get there, if you're sitting with 20,000 units over the next 10 to 15 years roll out, the combination of the pipeline, we need to ramp that up. but that will allow us to appoint bigger contractors and bigger scale construction. If you look at the Bankenveld project, there's no freestanding homes. It's a combination of anything from 4 to 7 story buildings. It's like a little inner city development rebuilding, and that will allow us to ramp up those numbers. So the target is to ramp the numbers up. First target will be to get back to our old numbers of the 1.5, but the target is there from there to actually growth, and there's potential to grow substantially above that, a 1.5 that was reported in the previous reporting period.
Ben, I know not this last question, the previous one you mentioned about the non-core assets, and we have a question on that in terms of, I think anybody who's done a home renovation, it doesn't always come in on time or on budget, and the question is kind of related to that. You've got a clear strategy to dispose of these like non-core assets and like return value to shareholders, but at the same time, you've got big projects kicking off like Bankenveld and a few other things. So I think the question is around, how do you balance making sure that those are disposed, there's a value unlock or return to shareholders without it getting swallowed up, by unforeseen, development issues. I don't know, they start drilling there and they find, bedrock that's now nearly impenetrable that like adds like suddenly 50 million to a project that, wasn't there in the initial geo survey or whatever.
Yeah. I think, Mark, the first thing is you must keep in mind we don't revalue our land. So all these projects that we're looking at non-core and disposing of, there's not the intention to incur any write-offs on these projects. They're currently on book at the time they were acquired. So it's a combination of what you paid for them plus the cost incurred to get the rights in place. So we typically, as developers, buy unzoned land. We acquire the land and then improve the rights before we dispose it. So there is an upside on that. On the smaller projects, the KZN is probably the one that we are happy to just say it's small. It's a 60 million rand investment. It's small enough to do that. But on the bigger projects, we're not going to get rid of them at all cost. In the returning market, we're seeing quite a bit of appetite of people saying, looking for land that's developable immediately, short-term returns. We're looking at the local election coming up next year. So there's pressure on public sector to actually deliver on that. So we see that in the appetite coming through, as well as the financial institutions, their appetite returning. So looking at that, yes, it will be a balance, but the intention is not to go and get rid of these developments at all cost.
Okay.
Got a question here about the Vredehuk project, which I'm not sure on all the details on, so I'm kind of going to ask it in a fairly open-ended way. Just more details on the status and timing. Is that a Western Cape? Is that a Cape Town City Bowl project? I mean, that would imply from the... Yeah, so the question is around whether, how you're thinking about that project in the context of it being quite high-end potentially. There was also a comment that hopefully you've paid the nuns from Nazareth House a fair price for it, but I'll just include that one as a comment in the question. So maybe just some details on Vredehuk, what you can share.
Okay, so Vredehuk has been a long time coming as well. I think the project is for the first time ready for implementation. We had the opportunity where we could actually start with earthworks just before or around about May this year. It wasn't the intention to go into construction heading into the rainy season. We're working in a built-up environment in the community, so it wasn't our interest to alienate everyone in the area by flooding their roads with soil all over. The project is now at a stage where it's ready for implementation. We've got the environmental requirements. I think the heritage approval was the biggest benchmark or hurdle that was reached, where there's a lot of specific design requirements to develop in that. Yes, it is high in the market. We're currently looking at our options of partnering with someone that specializes in that market segment. We might not just do it by ourselves, but yeah, we're looking at our options. We're ready for implementation, and like I say, it's been coming for years. We got our heritage approval and town planning approvals earlier this year, and yeah, we're in the process with the marketing teams to pitch the actual cost to market. So if you come back to the question, a fair price to the sisters, in hindsight, I think it was more than a fair price. All the value that we created by improving the rights and getting the project ready, they share in the upside. So it wasn't an outright acquisition where we paid for the land. They are paid by in units. So they take a certain portion of the completed units. So the longer it takes and the higher the sales prices, the more they actually take off the table.
Fantastic. Thank you. Marcus graciously let me go with one more question before we run out of time. I do have one more in my DMs. And the question is around management's remuneration incentives, the financial metrics they are linked to. And the question specifically is return on equity one of those incentives?
No. As we sit here, no. There's a REMCO coming up on the 12th of June where we're having the discussion. It's on the agenda. It was raised by more than one shareholder during this roadshow and this thing and say, what is being measured? You will see that the pot was missed this financial year. And I think we just all look at risk differently. The previous team take certain things and think will happen. As a new team, we just look at it and say, guys, maybe over-provided for some stuff that's created some uncertainty, so that pot was missed. But the return on equity question was raised in 3-4 meetings with our existing shareholders and say, can it be incorporated? So that's on the agenda for the 12th of June. Currently, no, it's not part of the package.
Great. Thank you very much for all those, for the presentation and the questions. Thanks for everyone who chose to spend time with us today in the session. And again, thank you, a special thanks to Ben, Pierre and Sari for making the time to support this investor platform and to engage with the investors. We hope that you've enjoyed the event. It will be on our YouTube channel soon, and we encourage you to subscribe for the videos, please. Our next session takes place on Thursday, the 29th of May, and that will feature a brand new company to unlock the stock, as well as a new listing to the JSE, which is Greencroach Renewables PLC. So we hope to see you on that call. The invitation is out. It's also on our website. That is all from my side. Thank you and goodbye.